Senate Committee on Banking, Housing, and Urban Affairs will come to order. We apologize for the delay this morning. We don't like to start the hearing late, but sometimes we have to. So thank the four of you for joining us. Good to see all of you. Some of you have been in front of this committee before or have worked around here before, so welcome, especially to those of you. This hearing is in a hybrid format. Our witnesses are in person. Members have the option to appear in person or virtually. Hard work should pay off for everyone. That's the American dream. That's what the dignity of work is all about. It's a concept that Pope Leo XIII spoke of in the late 19th, early 20th centuries, and a concept popularized by Dr. King. When work has dignity, you can support yourself and your family and your future, but we all know what's happened over the last 4 decades. Corporate profits have gone up, the stock market has soared, executive compensation has exploded, but wages have not kept up with the cost of living. Millions of workers with full-time jobs who aspire to the middle class can't join it no matter how hard they work, and even people we may define as middle class don't feel much security and stability. When workers are forced to find ways to make up for the gap between what they're paid and what they should earn, what are they left with? Debt. Sometimes people have to borrow money. Products that are well-designed and transparent and regulated can help workers pay off an unexpected car repair or help with a grocery bill or cover a medical expense. But as we heard at our listening session with workers last week in this committee, too often these products aren't well-designed, they're rarely transparent, they're not well regulated. For far too many workers, the only credit products available lead to more debt and more financial instability. We've discussed in this committee the impact predatory payday lenders have on working families. Today we examine the impact some newer consumer financial products have on workers. Companies tell us these new products are innovative, they're easy to use, they'll give people more options, but so often innovation is just a new way for companies to make money while trapping people in debt. Newer credit products, buy now, pay later, for example, could help consumers pay for products in installments with strong consumer protections. Yet many of these products come with hidden fees. They lack transparency. They aren't underwritten properly. Ads encourage consumers to use these plans for multiple purchases at multiple online stores, racking up debt they can't afford to repay. Consumers like Brianna Gordley. As a college student, Brianna started off with one of these loans. First, one BNPL company, then 2, then 3. One company told her they were raising her credit limit from $100 to $1,000. Initially, 18-year-old Brianna wasn't too concerned. As she put it, if the companies, quote, believed in my ability to repay my debt, then I did too. With the approval of more and more credit, Brianna was juggling $1,500 in loans with different payment dates throughout the month. Her account kept getting overdrawn. Brianna's story gets to the core of the problem. With little to no underwriting, buy now, pay later companies don't know if they're the only ones a consumer has credit with. And without proper term disclosures, a consumer's left in the dark. For this model to work for consumers, we need real rules companies must follow, and we need proper disclosure. Then there are new consumer products that use a so-called tip model, structuring themselves to deliberately avoid disclosing their terms, specifically avoiding important disclosures required by the Truth in Lending Act. Products like cash advances, overdraft coverage, earned wage advances that are not offered in conjunction with employers use a model where consumers are asked to pay a tip to the lender instead of a fee or an interest rate to use the products. Companies claim that because a tip is not presented as a finance charge, or an interest rate, Truth in Lending and other consumer protection laws like the Military Lending Laws Act do not apply. The tip is just, quote, voluntary, they say. But of course, they're not voluntary at all. It's just a way to cheat the system and hide the true cost to workers. Employer-based earned wage advances with strong consumer protections can, in fact, help workers cover unexpected expenses or emergencies, though the better alternative would simply be for the companies to pay their workers enough to live on. Then there are debt products that are so predatory, so offensive, they should have no place in our financial system. Schemes like training, repayment agreement provisions, appropriately known as traps. I'll say this for that term that was invented, it's certainly truth in advertising. These provisions and employment contracts allow employers to recoup the cost of training employees who leave the job. It's an offensive concept. It's the employer's job to train their workers. On-the-job training isn't some special perk for workers. It's a smart investment for companies. Traps require workers to pay back their employers for training if they leave their job within a certain period of time, saddling workers with debt. It's a modern-day version of the script that left coal miners exhausted, destitute, and trapped by their employers. Remember what Tennessee Ernie Ford sang about owing his soul to the company store? You load 16 tons, what do you get? Another day older and deeper in debt. Employers use traps to prevent workers from pursuing higher paying or better opportunities. They decide how much the training would supposedly cost on the market, and they go after their workers, threatening their credit and their economic mobility. Last week, Cassie Pennings from Colorado told members of the committee about her experience with traps. Ms. Pennings pursued her calling as a nurse during COVID-19. At the start of her job, her employer made her sign an employment contract. Buried in the fine print, it said that if she left before 2 years, she'd be indebted to her employer for $7,500 for the supposed training they provided. When she decided to leave her nursing job after a year because of a bad work environment, her employer took $1,000 out of her second-to-last paycheck to pay back her training. That was half of her paycheck. Her former employer told her they will send the rest of the amount to collections. Last I checked, indentured servitude was illegal in the United States of America, but it looks like some enterprising companies are rebranding it with these new employer contracts. That's the focus of today's hearing, to ensure that so-called innovation is not a substitute for good pay and does not come at the cost of workers' dignity of work. Senator Toomey.
Thank you, Mr. Chairman, and thank you for kindly delaying the start of this hearing. Thank you to the witnesses for your patience. I was unavoidably delayed. I appreciate the accommodation. Today's hearing, of course, is about new consumer financial products. In the last decade, we've seen financial institutions develop technology-oriented solutions to meet consumers' needs. These new choices create a more competitive marketplace, all of which benefits consumers. As long as consumers have truthful and accurate information about financial products, it's the consumers who are best positioned to decide what products to use. Any regulation of financial products should fit the product type, make room for innovation, and maximize consumer choice. Too often, however, the response from some of my friends on the other side of the aisle is to see something new and panic. Let's talk about some of these new products. One of them is called the Buy Now, Pay Later, or BNPL. BNPL typically allows consumers to make purchases now, often online, and repay them in 4 interest-free installments later. This service can be a very attractive way for consumers to manage their cash flows to obtain goods and services without having to pay any interest. That's especially true for consumers who don't have or don't want to use a credit card for such purchases. This may explain why BNPL is most popular among younger consumers who have shorter credit histories. If customers are late with payments, BNPL companies sensibly suspend further purchases until they're paid, and some charge a late fee. Interestingly, BNPL companies do not primarily make their money from consumers at all, but rather from retailers who pay them a small percentage of transactions to offer the service to customers. Retailers are willing to do this because they don't have to pay credit card interchange fees on BNPL payments, and offering BNPL can increase sales and customer loyalty. Another newer financial product that provides consumers with short-term funding is Earned Wage Access, or EWA. This service can be an appealing alternative to payday loans for workers who want an advance on their wages. Many people don't have savings available to pay for unexpected expenses that can arise in between pay periods, like car repairs or a medical bill. EWA can help consumers to meet such expenses and others by advancing them the amount of income they've already earned at that point in the pay period. Now, there are various EWA products available. In some cases, employers select and pay the fee for the service as an employee benefit, while in others, consumers must pay the fee. According to a recent study, the average fee a user paid per advance was between $2.59 and $6.27. That's less than 5% of the amount advanced. In short, the marketplace competition has successfully generated more and cheaper online options for many consumers to meet their needs. This is a reminder that market competition is typically better at helping consumers than the government, whether the product or service is in the financial sector or some other category. Other newer financial products include forms of credit that have existed for a long time, but with innovations in how they're provided. In recent years, financial institutions, primarily community banks, have begun to partner with financial technology companies, or fintechs, to offer improved products and reach more consumers. Bank fintech partners offer a large variety of credit products, including small dollar, personal, auto, and small business loans, as well as credit cards, mortgages, and home equity credit lines. And these partnerships can generate significant consumer benefits by lowering the price of financial products, expanding consumer choice, and increasing competition. Often they provide access to credit for higher-risk borrowers, such as consumers with lower incomes or no credit history, all through a highly supervised financial institution. Unfortunately, some bureaucrats and some lawmakers seem to react with hostility to almost any new financial products. Democrats in Congress have majority branded bank fintech partnerships in general as rent-a-bank schemes. Last year, they overturned an OCC rule that provided regulatory certainty for these partnerships. Unfortunately, by attacking legitimate bank fintech partnerships, our Democratic colleagues risk restricting access to needed credit for lower-income consumers. And then there's the CFPB. Under Director Chopra, the CFPB has repeatedly demonstrated hostility to innovation in consumer finance markets. For example, Director Chopra has replaced the CFPB's Office of Innovation with the new Office of Competition and Innovation in order to advance his efforts to involve the CFPB in antitrust and competition law, which is outside its jurisdiction. He also sidelined the Office of Innovation's programs to foster responsible innovation, such as no-action letters and regulatory sandboxes. I'm also concerned that the CFPB will bring this reactive anti-innovation perspective to its scrutiny of new financial products. Already, it's made public statements that suggest hostility towards BNPL and other products. All this hostility to new financial products is further evidence of the condescension and paternalism that we see sometimes in financial regulation. Individual consumers are better positioned than any bureaucrat or politician to understand their own individual needs and preferences and to make their own choices. Some of my colleagues ignore the benefits consumers derive from access to more choices in a more dynamic marketplace. The best form of consumer protection is a robust, competitive market. That's why, instead of curtailing new financial products, regulation should facilitate innovation and consumer choice. Thank you, Mr. Chairman.
Thank you, Ranking Member Toomey. I'll introduce the four witnesses. Left to right, Ms. Rachel Gittleman, the Financial Services Outreach Manager for the Consumer Federation of America. She leads CFA's advocacy and outreach on high-cost lending, payday loans, and other banking and credit issues. Welcome, Ms. Gittleman. Ms. Penny Lee is CEO of the Financial Technology Association. She served previously as Chief Strategy Officer of 1776, a technology incubator. She previously served as Senior Advisor to Senate Majority Leader Harry Reid. Ms. Lee, welcome. Professor Todd Zawicki is somewhat of a regular in this committee. He's George Mason University Foundation Professor of Law at the Scalia School of Law. He's a Senior Fellow at Cato, Chair of the CFPB Task Force on Federal Consumer Financial Law in 2020. Mr. Zawicki, welcome. Mr. David Seligman is the Executive Director of Towards Justice. He's litigated several class and collective actions to attack systemic injustices in the labor market. Clerk for Chief Judge Patty Saris of the District of Massachusetts. Ms. Seligman, welcome. And Ms. Gittleman, if you would begin your testimony. Thank you.
Chairman Brown, Ranking Member Toomey, members, thank you for the opportunity to testify before you today. I'm Rachel Gittleman, Financial Services Outreach Manager at Consumer Federation of America, a nonprofit association of national, state, and local consumer groups focused on advancing the consumer interest through research, advocacy, and education. New consumer credit products are exploding across market areas. Some of the fee models, schemes, and provisions discussed today are inherently deceitful and predatory. Others may help certain consumers manage their finances, but even those are not risk-free. Regardless, at their core, each of the products discussed today are credit. They provide funding or the promise of funding today and are repaid later, and should be covered by basic consumer protections at the state and federal level, especially given that they are disproportionately used by and marketed to lower-income consumers and consumers of color. Buy now, pay later products allow consumers to pay a portion of a purchased item upfront and the rest of the debt in 3 often interest-free installments over a set period. but they can lack underwriting for a consumer's ability to repay, leading to unmanageable amounts of debt. Consumers can face cascading fees, negative credit reporting, debt collection, and difficulty with disputes and refunds. Earned wage advance products are funds advanced by a third party to a consumer before their regular payday. Fee-based earned wage advances are ostensibly a lower cost form of a payday loan, requiring workers to pay to get paid. And they can lead to the same cycle of reborrowing as other balloon payment loans. Even free EWA products may still create a hole in next week's paycheck, leading to a cycle of debt. Fake earned wage advance, overdraft protection, and other cash advance products that collect tips are simply disguising finance charges under a new name. Tips are not truly voluntary, as they are structured so that it is difficult to avoid tipping. Consumers feel obligated to tip, like in a restaurant or service setting, but unlike those settings, tips do not go to another human being, but rather to the company's bottom line. The true cost is not clear to consumers, and tips add up quickly, costing nearly as much as traditional payday loans in some instances. Hidden deep inside employment contracts, training repayment agreement provisions trap consumers in low-paying jobs by requiring repayment of large fees for on-the-job training or orientations. This debt is enforced if a consumer leaves either voluntarily or not before an arbitrarily determined date. Traps indebt the consumer to the employer with the threat of high interest rates, attorney and collection fees, or withholding of other benefits. Importantly, these products are credit and should be viewed and regulated as such. Failing to do so will lead to further evasions of credit laws. Therefore, CFA recommends that state and federal regulators supervise fintech providers to ensure they are compliant with credit, fair lending, and consumer protection laws, as well as not engaging in unlawful discrimination or unfair, deceptive, or abusive acts or practices. Regulators should closely examine evasive pricing models. Providers should only offer products after determining a consumer's ability to repay, and loans should be structured in an affordable way with proportional penalty fees. The cost of credit should be portrayed to consumers as an annual percentage rate so that they can compare products. Consumer data should be used in a responsible, transparent manner. State and federal regulators should collect, analyze, and publish data to better understand and illuminate the risks of these products. And state and federal regulators should work together across agencies and levels of government to ensure consumers are protected and predatory actors are held accountable. Oversight is especially needed, as each of these products is either disproportionately used by or marketed to low-income consumers and consumers of color. Without meaningful, holistic underwriting, affordable repayment options, and price transparency, products may do more to exacerbate financial exclusion rather than promote financial inclusion. Each of these products should not be allowed to use the guise of innovation, the cover of a lengthy employment contract, or a borrowed label to shield themselves from federal and state oversight and regulation. Thank you for your consideration, and I'm happy to take any questions.
Welcome.
Thank you, Chair Brown, Ranking Member Toomey, and members of the committee today for allowing me to testify. I am the Chief Executive Officer of the Financial Technology Association, a nonprofit trade association representing industry leaders shaping the future of finance. As we've seen, fintech adoption has surged over the past few years. 9 in 10 consumers use financial technology to manage their finance. Consumers confirm it saves them time and money. 73% says it helps them make better financial decisions, and 71% says it helps reduce financial stress. Today, unfortunately, Americans are more likely to report they are worse off financially than they were a year ago. With prices rising, millions continue to struggle to make ends meet, and cash flow stress makes it difficult for many Americans to cover essential costs while waiting on a biweekly or even monthly paycheck. Fortunately, fintech is creating new tools for consumers to improve their financial security. Financial innovation allows a single mom the ability to buy medicine for a sick child, or a parent the ability to purchase new school supplies that better fit their household budgets and finances. I will focus my remarks today on a few particular areas of fintech innovation in the Buy Now, Pay Later and Earned Wage Access spaces. Buy Now, Pay Later, BNPL, is an alternative payment option enabling consumers to manage their cash flow and avoid paying high interest rates and fees. As you alluded to, the typical pay in 4 model provides small, low-cost, short-term payment options, usually 4 installments over 6 to 8 weeks, with no extra fees if the consumer pays on time. BNPL generates the vast majority of its revenue from partnerships with merchants, not consumer fees. According to a Morning Consult poll conducted on behalf of the FTA, more than 3/4 of BNPL users have a favorable opinion of the service and trust it to do the right thing for consumers. 77% of adults using multiple BNPL companies said it actually makes it easier to pay for purchases. The Financial Health Network's recent study found that 99% of BNPL users understood the terms and conditions of the service. 96% had no difficulty making payments, and only 4% were late or missed 1 or more payments. Importantly, BNPL also supports America's small businesses by enhancing the customer experience, facilitating economic activity, and driving consumer satisfaction. BNPL products are also subject to consumer protection regulations, including anti-money laundering, fair lending, debt collection, privacy, fair treatment of consumers, and electric fund transfers. They are also subject to similar state consumer protection laws. I'll switch now to another financial product that we mentioned, earned wage access. EWA is a critical area of innovation that offers workers flexibility through on-demand and early access to their already earned wages, helping them make timely payments and avoid overdrafts and manage any short-term financial shock. EWA services can provide consumers with a more flexible and less expensive way to avoid missing a bill or sliding into debt. Without these services, 44% of consumers would be unlikely to pay their bills on time, and 38% would consider going into overdraft. EWA services are non-recourse and do not charge interest. That means that consumers have no legal obligation to repay, and providers cannot take legal action to collect payments. All EWA models are subject to consumer protections, including fair treatment of customers, UDAP laws. On behalf of FTA's member companies, I appreciate the opportunity to engage with the committee today on these important issues. FinTech innovations are driving competition and providing consumers greater choice that result in lower costs and better financial outcomes. We strongly believe that balanced and thoughtful regulation is key to long-term success for all involved stakeholders. I look forward to helping inform this important discussion today. Thank you.
Thank you, Ms. Lee. Mr. Zawicki, welcome.
Thank you, Chairman Brown and Ranking Member Toomey. It's a pleasure to appear with you again today. Thank you. FinTech, I think, is a very exciting development generally, and I think the products that we're focusing on today, EWA and BNPL, are good examples of the potential for FinTech to improve consumer welfare, especially with respect to consumers who've traditionally been excluded, who have thin files or no files for credit, and also importantly, are very important vehicles for promoting innovation, but also competition against incumbent providers who can often get lazy if they don't have somebody nipping at their heels. I think the reality in this country is that middle-class consumers do pretty well in consumer credit markets today. Obviously, there's issues around the margins, but with respect to mortgages, credit cards, and the like, markets are transparent, competitive, plenty of choice, plenty of innovation. Consumers have very little trouble finding the products they want. But a perennial issue in American history is what to do with people who don't necessarily qualify for these top-notch and high-quality products that we have. And this has been an issue that's recurred again and again in America, and we see it with respect to the issues that these FinTech providers are providing, which is first, what to do with wage workers who live paycheck to paycheck, and life doesn't occur on 2-week cycles, and sometimes you need money in between for bills, emergencies, and the like, as well as people who have opportunities to purchase valuable products, and in particular, consumer durable products can be seen as a capital good by a household. The value of a washing machine may be the most important investment you ever make in your life, if you think about the alternative being to schlep to the laundromat every weekend. And BNPL is a good example of that. And so what a lot of these products are doing are basically providing very useful, low-cost, and convenient solutions to problems that have been around for a long time. BNPL can be seen as an update of the old personal finance company or retail installment loan. And EWA is a very good solution to the problem of what was originally wage loans and now essentially are filled by payday loans. And what we've recognized over time and what history has taught us is innovation really is the way in which we have improved welfare for all American consumers, but particularly lower-income consumers. A good example was the development of credit scoring and credit reporting, systemized credit reporting systems in the 70s, which dramatically increased competition, expanded access to people who are traditionally weren't buddies with the bank manager and so couldn't get a credit card. And also especially broke down discrimination and promoted equality in markets by basically getting rid of the old sort of ways of which lending was done and replacing it with FICO scores and other algorithmic lending. And I think so I think there's great potential for these products. I think they've proven themselves. I think so far consumers have shown that they use them in a very valuable way. EWA users report at least that they are less likely to take overdrafts, less likely to use payday loans, less likely to pay bills late. That's obviously worth monitoring going forward, but they seem to be using it as an opportunity to smooth and sync up their income with their expenses. BNPL so far is more of a frothy market so far, but so far it's really been a godsend, it seems, for a variety of reasons, which is first, during the pandemic, BNPL purchases rose dramatically as people moved to online shopping, and it shows a very important flexibility in the consumer financial marketplace. It's also been especially high uptake by younger consumers. And younger consumers nowadays have, because of various reasons, including various regulations such as the Durbin Amendment, the CARD Act, younger consumers have less access to credit cards and the like, less access to bank accounts and the like. And so I think BNPL has really stepped in to not only make it less necessary for them to access those products, but also has allowed them to continue to shop and get the things that they need. And so it's both, so it's provided a useful solution to that. And I think the final lesson I would say today is over time, when new products emerge, they tend to be somewhat frothy, and there tends to be a lot of variety in pricing. Over time, competition and innovation tends to lead towards more standardization on its own. And my big concern at this point would be premature regulations that freeze the market, that impose unnecessary costs where regulations may be archaic and designed for products that aren't around anymore and ill-suited to this regulation. So I want to close by commending the CFPB very strongly for starting off by issuing an RFI, starting with the research, understanding what these products are, who these consumers are, what the risks are before plunging in. And I think that while we should have aggressive enforcement consumer protection laws, I think we should be wary of premature regulation. Thank you for the opportunity to appear today.
Thank you, Mr. Spooky. Mr. Seligman, welcome. Good to have you.
Good morning, Chairman Brown, Ranking Member Toomey. I'm the Executive Director of Towards Justice. Some tout employer-driven debt as an innovation of corporate employers and the financial services sector that we should celebrate and seemingly insulate from regulatory oversight. They suggest that these forms of debts are essential to workers who need access to credit to make ends meet, training to advance their careers, or the costs of starting up a job. But workers' difficulty meeting financial demands and advancing professionally do not arise because they do not have access to credit. They arise because far too many workers still do not earn a living wage or have a predictable schedule that will allow them to meet their most basic financial obligations. And far too many corporate employers, even as corporate profits balloon, seek to shift onto their workers their own costs, while undermining the most critical component of a worker's dignity and bargaining power, the ability to seek out other work that will pay them more and treat them better. To appreciate the importance of oversight and vigorous enforcement of worker and consumer protections, we should understand employer-driven debt broadly. Employer-driven debt affects workers like nurse Cassie Pennings, whose story you heard earlier. Ms. Pennings' contract with the hospital where she worked, including a training repayment agreement provision, like the contracts of thousands and thousands of other workers, truck drivers, hairstylists, social workers, and employees of PetSmart, among others. By trapping workers in these jobs, these arrangements run counter to the principles of fair competition that we've heard so much about today. Employer-driven debt also affects the immigrant cleaning workers who come through my organization's doors, complaining that they were sold a sub-minimum wage job dressed up as a cleaning company franchise, and told they could finance the startup costs and franchise fees through their purported franchisor, who then trapped them in a vicious cycle of debt and modern-day indentured servitude. Employer-driven debt affects countless retail and service workers whose work schedules are unpredictable and variable, making it hard for them to make ends meet. But instead of a fair schedule or a consistent living wage, their employer offers them short-term loans to bridge the gap, loans whose true costs are often not disclosed. Workers cannot address the harms of employer-driven debt on their own. They are deterred by pervasive misclassification, forced arbitration clauses, and the threats that their employer will punish them through aggressive debt collection, whether or not the contractual provision permitting that collection would ever be enforced by a court. It's imperative, therefore, that federal agencies provide regulatory oversight and vigorous enforcement in this space. The Consumer Financial Protection Bureau can guard against unfair, abusive, and deceptive practices related to these products. Look out for predatory employer-driven debt arrangements that target immigrants and people of color in violation of the Equal Credit Opportunity Act, and ensure that protections like the Fair Debt Collection Practices Act apply to employers' efforts to aggressively collect debts that trap workers. Agencies like the FTC and Department of Justice can police and regulate the market for employer-driven debt that unfairly and illegally impedes worker mobility or even that keeps workers trapped in violation of laws prohibiting trafficking and peonage. Finally, when employer-driven debt seeks to recoup the employer's costs, it may be an illegal kickback against workers' wages in violation of minimum wage laws. In the case of training repayment agreement provisions, when, as is often the case, the underlying training is not principally for the employee's benefit, but is instead standard training for the benefit of the employer, the employer-driven debt is likely a minimum wage violation. In these cases, the U.S. Department of Labor can ensure that employers do not keep workers trapped in jobs through threats to collect such debts. Workers don't care if we understand their challenges as consumer protection challenges or labor challenges or competition law challenges. What matters to them is that government is there to police abuses of corporate power and level the playing field. We appreciate this committee's attention to this important matter.
Thank you, Mr. Seligman. The questions, some questioners may be hybrid, so I'm sure you're aware of that. Start with Ms. Gittleman. With the new consumer financial protections the committee's discussing, to products the committee is discussing today, it's important at the outset to establish what type of financial products that they are. So my question for you, Ms. Gittleman, first question, are buy now, pay later, earned wage access, and other types of products that use the TIP model you discussed, are they a form of credit that falls within the purview of existing consumer protections?
Yes, thank you for the question. Each of the products discussed today are, in fact, credit and should be treated as such by both consumers and regulators alike.
Mr. Seligman, are TRAPS, the acronym TRAPS, which leave the consumer in debt for their employment training, is that considered credit?
Yes, absolutely, and they should be covered by consumer protections. I will say that some employers may argue that the underlying training is not for the benefit of the employee and the personal benefit of the employee, and therefore is for the benefit of the employer. But in those cases, again, the trap is a violation of minimum wage laws, and that's why it's so important that we have coordination between the Department of Labor and the CFPB on these issues.
Thank you. As you both have said, these products are credit and relevant consumer protections like TILA and the Military Lending Act and state usury caps should apply. I'm glad, as you mentioned in your testimony, that CFPB, under the leadership of Director Chopra, has launched an inquiry on some of these products and is acting like the consumer watchdog that job was created to be. Mr. Seligman, training the TRAPS, training repayment agreement provisions, raise the troubling prospect of an economy in which employers prey upon their workers' optimism to bind workers to their firms, turning debt into a tool for coercion, limiting economic mobility. You've discussed that. My question is, by saddling workers with debt, limiting their freedom to move or search for a job, do traps limit worker mobility? If you would comment on that.
Absolutely, and in fact, I think that's the purpose on the employer side. We often see that the debt at issue far exceeds the value of the training. So in a recent case, for example, a trucking company sought to collect $6,500 from workers for whom it had paid training costs that didn't exceed $2,500. So it's not an effort to recoup the reasonable cost of training, but very obviously on its face, an effort to trap workers.
So how does limited worker mobility impact individual households? You've said what this means for employers. It obviously means limited mobility for employees. How does that impact individual households? How does that impact the broader economy?
Thank you. The costs of these types of arrangements, which indenture workers, can be devastating. We've spoken to workers who are trapped in abusive employment relationships, to workers who aren't being paid a living wage, who are not being paid what they're owed. That can be incredibly traumatizing for workers. Additionally, there's lots of data from the non-compete context which identify how these types of arrangements suppress wages. We know that they also interfere with the ability of competitors to hire workers that will increase productivity and be paid more and treated better.
Expand on that a little bit more. How it threatens wages and salaries, and then how it undermines future job opportunities. Walk that out a little for us.
Absolutely. One of the most important tools that any worker has in the employment relationship, core to their bargaining power, is the threat of exit, the threat of being able to go and work somewhere else. Employers understand this, right? And in an effort to suppress wages, even as their profits grow, many employers have sought to artificially undermine worker mobility, and as a consequence, that traps workers in jobs in which they're not treated as well as they ought to be, but also which they in a labor market which they don't have the power to earn the wages they're owed.
And you can see how these provisions, these actions, undermine the dignity of work and what that means for workers. And as I said before, I look forward to seeing the results of the CFPB's inquiry and how we move forward towards the CFPB's always looking at consumer protections, but also anti-worker practices. Last question, Ms. Gittleman. Earlier this week, Brianna Gordley from Texas testified that the buy now, pay later credit she took out was initially manageable until a variety of BNPL companies approved her for more than $1,500 in credit combined. She was a college student at the time she took out those loans. Does that sort of underwriting meaningfully assess a borrower's ability to repay? For example, do these companies assess whether a consumer has multiple BNPL loans with different providers?
No, most providers do not meaningfully assess a consumer's ability to repay. As it stands right now, there's no way for companies to verify how many loans consumers have across different providers. And for many providers, consumers need only provide a payment form, verify their identity, and do a soft credit check, which again does not meaningfully assess a consumer's ability to repay.
Thank you. And considering that 1/3 of consumers who use BNPL missed one or more payments, and of those consumers, 72% reported a decline in their credit score, it seems that those underwriting standards need strengthening. Senator Toomey.
Thank you, Mr. Chairman. Mr. Zawicki, it seems to me that a lot of the innovations in fintech are designed, in many cases, to provide a service to people who seem to be mostly left out of existing financial products, or at least with respect to credit. And it's disruptive to the incumbent players, but it creates whole new opportunities for these consumers. So could you just share for us, what do you think is the best way to think about regulating? Take the BNPL, or for that matter, the Earned Wage Access. How should we think about going about the regulation so that we don't stifle the innovation of these products or the next generation that we haven't thought of yet?
Thank you for that question, which I think is the big question on the table here. And I first want to agree and associate myself dovetails with your observation, which is that I think the great promise of fintech is with respect to traditionally underserved consumers, which is, again, the market works pretty well for middle class consumers, upper middle class consumers. We have plenty of options, high quality options, and the like. But it's always been this problem of serving underserved consumers, and the real problem has always been cost. It's very costly to make small loans. There's a lot of fixed cost involved in making a loan, and fintech potentially unlocks that by providing low-cost options, slick, kind of transparent, competitive options that don't have a lot of overhead and the like. And so what my big concern is taking regulations, a regulatory structure that's very archaic, that really dates back to the 1970s, which is a world of sort of pen and paper, maybe early prototype computers, and trying to take that regulatory scheme, which is already pretty creaky around the edges and doesn't work very well and doesn't fit a lot of products very well, and trying to pose that on the new fintech economy, I think could really be a problem, which is it's not really designed for that. Bad regulation can have costs with very few offsetting benefits. And I think the real issue we should be focusing on is ensuring that we are protecting consumers. So sometimes that means we should be doing more aggressive enforcement and less reliance on information, promoting competition, promoting innovation, and the like.
And just to be clear, so are you aware of data that suggests that the consumers who actually use BNPL facilities tend to be younger, lower income, maybe have a history of credit problems? Are they in fact the people who have a more difficult time obtaining credit?
Absolutely. They seem to be the people relying on it the most. There's some middle class people who are kind of doing it as a gimmick, I think. But really, the value proposition here is for lower income, younger, traditionally excluded consumers.
Okay. So then it becomes important that these consumers understand what it is they're getting themselves into. That's certainly important. Ms. Lee, are you aware of evidence regarding whether or not consumers actually understand the terms of the transaction? I'm referring specifically to BNPL products.
Yes, there's been two different studies recently, one from the Financial Health Network, which said 99% of the consumers who used BNPL products understood the terms and conditions. And recently, this last weekend, Morning Consult did a survey as well, and they found 94% of the consumers that used BNPL products understood the terms and conditions. I think that's a very high mark of people that really understand what these products are about, what their obligations are, and have full understanding of the terms.
So I know there's some people who are concerned that these BNPL companies take advantage of consumers. But let's think about the transaction here. First of all, typically it's zero cost. There's no interest rate paid. The fee that is paid and the income to the BNPL company typically comes from the merchant, who has plenty of incentives to pay that fee. So I guess the risk to the consumer would be if you don't make a payment on time, you could get hit with a late fee. So what do we know about how prevalent late fees are, how many consumers are hit with them, how big a percentage of BNPL companies' income derives from late fees?
So a couple of different things I'll try to unpack there. As far as on the late fees, what we know from, in general, in the industry standard, less than 4% actually incur a late fee. So we have a predominant...
Less than 4% of consumers.
Less than 4% of consumers using a BNPL product incur a late fee. So 90% of those using do not incur. They pay on time, and it is able to manage and fit their budget accordingly. And so that's why you're seeing the increased use of these, is because it's allowing them to fit their budgets. As far as on the derision of how much of the companies derive their revenue from that, around 85 to 87% of companies derive from merchant fees. There are other fees put into there, either a late fee or otherwise, but 85 to 87% of a BNPL companies come from merchant fees.
Right. Thank you very much. Thank you, Mr. Chairman.
Senator Warren from Massachusetts is recognized.
Thank you, Mr. Chairman. So last month, President Biden made the historic decision to cancel up to $20,000 in student loan debt. And this is going to deliver life-changing relief for as many as 43 million middle class, working class Americans. It's going to be nurses and truck drivers, nail technicians, and millions of people who are not able to finish their degrees. So while families are breathing a sigh of relief, corporations that made billions of dollars off a broken student loan system are now busily laying new traps in a shameless last-ditch effort to try to line their pockets. Navient, one of the world's largest and worst loan servicers, is now leading the way. According to reports, immediately after the cancellation was announced, Navient sent multiple emails to borrowers encouraging them to refinance their federal loans under Navient's private lender, Navi Refi, with the promise of lower interest rates. Now, Ms. Gittleman, your organization has a long history of protecting consumers from student debt scams, so I want to ask you, let's say a borrower decides to take Navient up on their offer and refinances their federal loans with a Navi Refi tomorrow. What would this mean for cancellation under President Biden's plan?
Thank you, Senator Warren, for the question. If they refinance with Navi Refi, then they will essentially be replacing their federal student loans with a private student loan. Because only federal student loans are eligible for cancellation, that means they may no longer be eligible for that cancellation. That's a huge loss for borrowers eligible for cancellation, but Navient only mentioned this in the fine print at the bottom of those emails.
So they could be forfeiting $10,000 to $20,000 worth of debt cancellations. In other words, right after the president announced student loan cancellation, Navient sent out notices to people who could be eligible, encouraging them to refinance so they would not be eligible for debt cancellation. Now, we don't know at this point exactly which borrowers Navient sent these emails to, although I have sent a letter asking for more information from Navient. But it appears that instead of sending borrowers information to help them get the cancellation that they may be entitled to, Navient pushed borrowers toward loans that could, at best, complicate their ability to get cancellation. Ms. Gittleman, does Navient make more or less money if its borrowers get their loans canceled?
The future of Navient's lending business depends on its ability to take the most credit-worthy people with federal student loans and refinance them into private loans. Every borrower who is debt-free as a result of President Biden's action is one fewer prospective customer for Navient. More broadly, the better the deal the federal government offers borrowers with federal student loans, the less opportunity Navient has to sell people its private loans.
So I just want to underscore what you just said. Every borrower who is debt-free is one less borrower for Navient to profit from. I think that was a fair summary. Is that right? So no wonder Navient is trying to steer borrowers away from cancellation. Look, this is outrageous behavior, and it's why I sent letters to Navient and to other loan servicers yesterday, asking them what steps they're taking to ensure that consumers receive timely and accurate information about their loans and their eligibility for cancellation. By the way, this is not the first time that Navient has been caught trying to take advantage of borrowers. Between 2009 and 2019, there were at least 10 incidents where Navient or its corporate predecessor, Sallie Mae, was accused of or fined by federal and state regulators for actions that ripped off borrowers, including steering borrowers to repayment options that actually made it harder for them to pay back their loans, failing to report borrower complaints, and harming disabled veterans' credit reports. Policymakers need to keep a close eye on servicers to ensure that borrowers are protected as they await debt cancellation, and I'm going to continue fighting to make sure that happens. Thank you, Mr. Chairman.
Thank you, Senator Warren. Senator Warner from Virginia is recognized.
Thank you, Mr. Chairman, and I appreciate you holding this hearing. I think back, I've been on the committee for a long time now, and when we used to look at the non-bank sector, we thought about it in the on the commercial sense, and asset-backed securities, CDOs, repos, and there were some benefits there. But then when we saw in the financial crisis, they were also the source of a lot of economic meltdown. We've seen since the financial crisis, and I think it's not really been, and it's one of the reasons why I appreciate you holding this hearing, is that we've seen now a migration in the non-regulated part of the financial industry, a massive amount of new consumer products come up in this area. Matter of fact, bank share of mortgage originations fell from 91% to 32%. The share of small business loans and unsecured loans dropped by 10% from the regulated industries. And we've seen this in a whole host of new areas. And we've spent some time, I think I've still got to get more education on issues like crypto, but we've seen specialized fintechs, peer-to-peer networks, frankly, some of the big tech firms getting into the payment space. And some of these things bring real benefits, but I think we focus sometimes on almost exclusively on the benefits and not on some of the challenges. The truth is, I think there are reasons that we have regulated financial institutions, and with that regulation, while there are burdens, there also comes, I think, some benefits. I'm going to start again with you, Ms. Gittleman. Your testimony states that new products are, quote unquote, exploding across consumer markets. How should we keep an eye on these new products, recognizing a lot of consumers like them, don't care whether it comes from a regulated entity or non-regulated entity? But my concern is, how do we make sure that we are guarding the protections for the consumers in this non-regulated banking sector?
Thank you for the question, Senator Warner. We have federal and state regulators, right? And regulation and oversight of markets benefits everyone, right? There is more competition. Regulated entities have a clearer expectation of what is allowed and what's permitted, and consumers benefit from being protected and knowing that they are protected. We've appreciated the CFPB's inquiry into BNPL providers, and we look forward to seeing what research that they found. But we would also encourage them to supervise, the fintech lenders that we are talking about today, right? Under various different authorities that I can get into and that are in my written testimony. But we would encourage them to supervise each of these industries so that consumers are protected and that the regulated entities, have a very clear sense of what is permitted.
Let me, I know I was a big advocate a number of years back of more experimentation in the fintech sector. And I know there was probably some disagreement even on my side of the aisle about when OCC was talking about kind of voluntary charters and some critique of that would be almost regulation light. I personally think we may be ought to revisit that because at least it sweeps some of these entities into some regulatory structure. I fear that the kind of, whether it be CFPB or this hodgepodge of state regulations doesn't give the clarity that we need. And I'd like to, basically the rest of the panel to address from your organization's standpoint, with the proliferation of these new products. And again, consumers probably not caring at the end of the day, whether it's a fintech, a bank, a credit union, they just want to get the products. But how do we make sure that we put some framework around this? And it's very nice to see you, Ms. Lee, in your new role, and I'd love to hear from the rest of the panel on that subject.
Good to see you, Senator. And on that subject, I would say that there's kind of, with the products that we're talking about here today in particular, but larger, there's three different ways. One is to enter into state agreements with money transfer licenses, and that would put them in, once they are licensed, and they are also under examination for the abilities of which they do, which is on the money transfer. They can enter into bank fintech partnerships. When they enter into bank fintech partnerships, they are subject to the oversight of the state and federal banking systems. They own overdraft and other things, and to ensure their fairness and safety and soundness. And then third, to your point, they can go pursue their own charter, their own banking charter, whether that be through the OCC, through an ILC, or through other means. And I would say many of our member companies seek that. Unfortunately, there's not necessarily been a moratorium, but there's been a very slow acceptance of having special purpose or other types of national bank charters. many fintech companies are asking to be in that in a more regulated space to be able to fit the purpose of what they're trying to accomplish. We would welcome the opportunity for the various different regulatory bodies to be able to approve those, so that you can have a fullness and an understanding of what these partnerships look like.
The other panel members could quickly address that.
Thank you. I'll be brief. Thank you for that question. I agree. It's a big problem, the hodgepodge of state regulations when it comes to fintech. Fintech only really works on a national basis, right, to make the economics work. As the chairman of the CFPB task force, I think somewhat controversially, we recommended that the CFPB be given chartering authority for non-bank financial services institutions. I believe the OCC fintech charter could work. I also fear that if the OCC is in charge, that the big banks will co-opt the process to impose unnecessary burdens on them. And so I would suggest considering something like the CFPB be given the authority to charter non-depository consumer financial providers.
Thank you, Senator. You asked what frameworks apply, and I'd suggest that in most cases we have the frameworks, right? These products are credit, as Ms. Gittleman testified to, and we shouldn't allow the fact that they're dressed up in fintech terms or sometimes bound up with the employment relationship to alter our perspective on that critical point.
I would simply, I know I expired, Mr. Chairman, but I've also been looking at the question. There's a lot of ancillary products that are kind of sold into the regulatory industry, and there's actually an affiliation of regulators that look at how those products are sold in. That might be an area I can learn a lot more about, but it might be another framework, because we're talking about consumer protections here. We could make the same kind of question about cyber protections in this area, and the idea of this whole sector going without any framework of oversight. I frankly don't think the hodgepodge state regulatory system is going to meet the mark, but appreciate you holding the hearing.
Thank you, and thanks always for your insights. Senator Reed from Rhode Island is recognized.
Thank you very much, Mr. Chairman, and thank you to the panel. Ms. Gittleman, I've introduced S2508, the Veterans and Consumer Fair Credit Act, with Chairman Brown and several members of the committee. And this legislation would establish a nationwide interest rate cap of 36%, with the goal of eliminating predatory loans from our consumer credit markets. We already have something similar to this with the Military Lending Act, where we're protecting our servicemen and women with this same limit. Can you give us some examples of the new and emerging products that appear to be consumer friendly, but in practice are predatory and really exceed 36%?
Thank you, Senator Reed, for this question and for your advocacy on the Veterans and Consumers Fair Credit Act, and Chairman Brown as well. Finance products that use the TIP model are an example of this. Pricing can look very affordable on the outset, but can reach as high as traditional payday loans. Other loans, that we haven't necessarily talked about today, but I addressed in my written testimony, that are offered online or through a smartphone application, and those that use, especially those that use the rent-a-bank scheme, to peddle high-interest loans, even in states where those rates are illegal.
You mentioned the rent-a-bank arrangements. Can you do how they avoid the state usury limits?
Sure. So banks are largely exempt from state interest rate caps, and high-cost lenders have used this exemption to launder their loans through banks in order to evade state interest rate laws. This is not a true bank partnership like Ranking Member Toomey was speaking about. The high-cost lender has the predominant economic interest in the loan. They're doing the majority of the underwriting, reaping majority of the benefit, taking on the majority of the risk. And they either name the bank at the very end of the agreement, or they pass the loan through the bank in order to evade that state interest rate cap. And last year, Congress, in a bipartisan rebuke, rebuked these partnerships, these rent-a-bank schemes. But the Veterans and Consumers Fair Credit Act would protect consumers from these high-interest loans that are evading state interest rate caps.
Thank you. There's another product that's becoming more prominent. That's the buy now, pay later. And these loans allow consumers to split payments for products like electronics and clothing into 4 equal installments, typically, that are due every 2 weeks. And they've been very, very popular in the pandemic. In fact, according to the Mercator Advisory Group, $55 billion in buy now, pay later credit was extended in the last year in the United States, and they're projecting an expansion more than $100 billion by 2024. Which consumer protections law do apply to buy now, pay later loans, and which do not?
We would argue that most consumer protection laws should apply to buy now, pay later. As it's being structured more and more like open-end credit, TILA should apply. With finance charges and mandatory arbitration agreements, the Military Lending Act should apply. As it's commonly used by consumers of color, ECOA, the Equal Credit Opportunity Act should apply. Since many products require or include authorization for payments to be automatically deducted, the Electronic Funds Transfer Act should apply. For products that allow consumers to consent to debt collection in the initial terms and agreements, the Fair Debt Collection Practices Act should apply. And finally, federal regulators should supervise buy now, pay later providers and ensure that they're not engaging in unfair, deceptive, or abusive acts and practices or unlawful discrimination.
It's also my understanding that the BNPL lenders do not report to the credit bureaus in any standardized fashion, which complicates evaluating the credit of an individual for other types of loans. Is that accurate?
So we are in the beginning processes of having that buy now, pay later data incorporated into credit reports. It is not done in a standardized manner. Each of the credit reporting bureaus have their own format of incorporating and using that data. And it might both not only have underwriting consequences, but also credit reporting and credit scoring consequences as well. FICO scores of credit reports that have incorporated said data have lowered slightly, and it just illustrates that at best, the current credit reporting system is an awkward fit for buy now, pay later. It is not, traditionally what fits into the credit reporting system, and so this needs to be done thoughtfully to ensure that consumers are protected.
Well, thank you very much. Thank you, Mr. Chairman.
Thanks, Senator Reid. Senator Van Hollen is recognized from Maryland, is recognized from his office, I believe. I thought he was here. Senator Cortez Masto of Nevada is recognized from her office.
Thank you, Mr. Chair, and thank you to the panel members. So appreciate this conversation. And by the way, if some of my colleagues don't remember, I do, in 2007, when there were new financial products that were offered by Wall Street called mortgage-backed securities. And then they were followed by other financial products, teaser rates, adjustable rate mortgages, interest-only loans to borrowers. That led to the subprime mortgage meltdown that caused the recession starting in 2007. So I do think it is appropriate for us to be having this conversation today, and so appreciate the panelists here for their comments so far. Mr. Seligman, let me start with you. I've done some work around franchises, and I've been long concerned about unfair practice related to some franchise businesses. I don't know if you've seen, but I issued a report in 2021 called The Strategies to Improve the Franchise Model, Preventing Unfair and Deceptive Practices. Now, let me just say there are some models that are just very good business models. But as always, there are some predatory predators within the system, and those are the ones I'm highlighting. And so, Mr. Seligman, let me ask you this. How can the promise of an independent franchise sometimes become a way to trap workers in jobs with low wages and crushing debt?
Thank you, Senator. And first, let me say I appreciate your work in this space, standing up for small businesses and for workers. Very often, we see that predatory franchise opportunities target those who have been left behind by our labor market, who are excluded from some of our most hard-fought labor protections, disproportionately immigrants and people of color. And predatory companies can go to them and they can say, look, the traditional employment opportunities haven't provided you with a path to financial success. And so instead, let me sell you on a purported entrepreneurial opportunity, the opportunity to own a small business, to become a franchisee. Instead, these companies will trap workers in arrangements where the companies exert extraordinary control, where the workers don't have the ability to set their own prices or even sometimes communicate directly with their clients. And instead of being paid wages, the predatory companies will often say, you owe us a franchise fee. And because those franchise fees can be so high, we're going to finance those fees for you, right? We're going to loan you the money to pay for the upfront costs. This can create a really vicious cycle of predatory debt and effectively involuntary servitude.
Well, thank you. And I appreciate your comments because it is an area where I would hope my colleagues would join me of some legislation to help us level that playing field and just get more information out to potential franchisees. So thank you. Let me jump to training repayment agreement provisions and how it's impacting nursing. The U.S. Bureau of Labor Statistics reported that we need more than 179,000 nurses to meet our national shortage. And many reasons contribute to the shortage. However, I was shocked to see the prevalence of the training repayment agreement provisions among nurses, with repayments as high as $20,000. So, Ms. Gittleman, can you expand on the use of traps in the healthcare profession?
Sure. Thank you for the question, Senator. These traps are becoming more and more prevalent across different industries. They are infiltrating trucking, nursing, PetSmart employees, social workers, and into our medical field as well. And this is a form of employee-driven debt that not only traps consumers in that debt, but also hinders workplace mobility and exacerbates disparities.
Thank you. And Mr. Seligman, any other additional comments or things that we should be doing in Congress to address this, if anything?
Thank you. Yes, I just want to emphasize that in many of these arrangements, especially when it comes to immigrant nurses, we'll see employers justify extraordinary debts and training repayment agreements by saying that the worker entered into them voluntarily in order to have their visa sponsored. Of course, it's a fundamental tenet of our laws in this country that you can't sell yourself into indentured servitude. I think it's really important that we attack these practices as being unfair and illegal. And I'll also say, of course, like in this area, as in so many others, forced arbitration is at the root of the problem. So many workers are trapped and their rights are violated, even if, as I said, no court would ever enforce the provision that's trapping them in their jobs or purporting to authorize debt collection. They can't do anything about that because a forced arbitration provision prevents them from going to court, may require them to arbitrate in a far-off forum or pay the other side extraordinary costs.
Thank you. I know my time is up, Mr. Chairman, but thank you. And I couldn't agree more about adhesion, these arbitration contracts that are part of these, or these arbitration agreements that are part of these adhesion contracts. The consumer has no choice, doesn't get to negotiate these contracts. And that's why the arbitration clauses are so detrimental. Thank you, Mr. Chairman. I appreciate it.
Thank you, Senator Cortez Masto. Thank you for your reference to what happened a dozen or so years ago. Thanks to the witnesses, I would like to submit for the record the testimony of Brianne Scally of California, whose former employer made her sign a trap, putting her in debt for $5,500 to the employer after she resigned due to poor working conditions. I'd also like to submit for the record the testimonies last week, I said earlier this week, last week, of Brianna Gordley and Cassie Pennings. Their stories describing their struggles with employer-driven debt and new credit products is important context to what it means to be a worker living with debt. For senators who wish to submit questions for the record, those questions are due Tuesday, September 20th. Each of you on the panel, if you would, have 45 days, please, to respond. The hearing is adjourned. Thank you for joining us.